If you've been watching the news lately, you've probably heard about how costs will be going up for buyers with good credit to help buyers with lower credit. This is being accomplished by making changes to loan level price adjustments. In this video, we'll discuss what loan level price adjustments are, why they exist, the recent changes you've seen all over the news, and how they affect the interest rates you may be offered when applying for a mortgage. But before we do, my goal with these videos has always been about real estate education and guiding you through the process. So do me a favor, if you find any value at all in my content, go ahead and hit the like button and subscribe to my channel. While you're at it, go ahead and click on that bell to be notified whenever I post a new video. So what are loan level price adjustments? Loan level price adjustments, or LLPAs, were implemented by Fannie Mae and Freddie Mac in April of 2008. This was done in response to the large number of government-backed loans that went bad. These bad loans resulted in huge losses in the secondary mortgage market. These losses are what prompted the government bailout of Fannie Mae and Freddie Mac, which cost taxpayers $187 billion. That's billion with a B. With all those bad loans, Fannie and Freddie realized that they were undercapitalized and overexposed to risk. So they decided to increase fees. However, understanding that some loans were less risky than others, they didn't want to increase fees across the board, so in order to collect higher fees without penalizing low-risk borrowers, LLPAs were born. By charging higher fees for riskier loans, lenders can offset some of the potential losses they may incur if a borrower defaults. Simply stated, loan level pricing adjustments are literally adjustments to the price of a loan. The amount of adjustment is based on risk factors. Loan prices are what determine a borrower's mortgage rate. Higher loan prices translate into higher mortgage rates. Therefore, a higher risk equals higher interest rates. The amount of the adjustment and its impact on your interest rate will depend on several factors, including your credit score, loan-to-value ratio, and the type of loan you're applying for. For example, if you have a low credit score, you may be charged a higher fee, which will increase your interest rate. In addition, if you have a high LTV, you may also be charged a higher fee, since lenders consider higher LTV ratios to be riskier. Looking at this LLPA matrix, we can see how fees vary based on credit score and LTV. Let's compare two borrowers who each intend to put 15% down, one with a credit score of 640 and one with a score of 740. Here we can see that a borrower with a score of 740 will pay an LLPA of 0.25%. The borrower with a score of 640 will pay an LLPA of 3.25%. That's a 3% difference, which is significant.
Wow.
Again, the reason for the higher fee is because statistically, borrowers with a score of 640 are more likely to default on their loan than a borrower with a score of 740. A default will force a lender to foreclose, which is costly to the lender. Think back to 2008. In some cases, lenders might also charge fees for other factors that could increase their risk, such as having a non-owner occupied property like a second home or an investment property, or taking out a cash-out refi loan. These fees can also increase your interest rate, making the overall cost of your mortgage higher. So if LLPAs have been around since 2008, why are they suddenly headline news? It's because of changes being made to the fees beginning on May 1st, 2023. The changes will lower or remove fees for some high-risk borrowers and shift them to low-risk borrowers. The change will also add a new fee for borrowers with a greater than 40% debt-to-income ratio, or DTI. This DTI adjustment is scheduled to go into effect on August 1st. Let's compare the new matrix to the old matrix to see what has changed. Using the same example as before, we can see that the LLPA paid by the borrower with a score of 740 has increased to 1%, while the LLPA paid by the borrower with a score of 640 has been reduced to 2.5%. So why are these changes being made? According to the Federal Housing Finance Agency, the new rule is designed to assist low-income and underserved communities by lowering borrowing costs and encouraging home ownership. Lowering the LLPAs will mean lower interest rates, which translates to lower monthly payments. Loan amounts are generally based on monthly payments, so the lower payments will allow more people to qualify for higher loan amounts. Not everyone is happy about these changes. There are complaints that the new rule unfairly penalizes borrowers for having good credit and rewards those who accrue debt and don't pay their bills. This effort to get more Americans with lower credit scores into homeownership is essentially being subsidized by the borrowers who have better credit scores, basically punishing good behavior and rewarding bad. On average, the change will add about $60 per month to the loan payments of lower-risk borrowers. In summary, loan-level price adjustments are fees charged by lenders to adjust the interest rate offered to borrowers based on their risk profile. They exist to help lenders manage the risks associated with lending money to riskier borrowers. The new rules will shift some of the fees from high-risk borrowers to low-risk borrowers. These adjustments can have a significant impact on the interest rate you may be offered when applying for a mortgage. It's important to understand how they work and how they can affect the overall cost of your loan. There are many factors that influence the interest rate offered to you by a lender. The only way to get a valid estimate of what your rate will be is to speak to a qualified mortgage professional. I've worked with many local lenders over the years and would be happy to recommend a mortgage professional that will do a good job for you. Just call, text, or email me to get started down the path of home ownership. Till then, this is Lucian Valancourt with Native Sun Realty, helping you find your place in the sun.